Welcome to This Week in Money, the source for market opinions, brought to you by AmericanManganeseInc.com. Here is Phil Mackesy.
Bob Hoye is Chief Financial Strategist for Institutional Advisors. He writes Pivotal Events, a weekly overview, and you can find out more at institutionaladvisors.com. Hey, Bob, it's good to have you back on This Week in Money.
Well, we're here. It's good to be anywhere these days.
Let's start off by dipping into the This Week in Money mailbag. We got a question here from our friend Frank de Beer, who always sends us interesting notes from Belgium. Frank says, this week a university in Belgium gave Christine Lagarde, the head of the IMF, the highest possible degree for her outstanding intervention and leadership in solving the European financial crisis. I didn't know it was solved, but I guess it is. Frank asks, how long will it take before we wake up from the ridiculous policy shows that we're witnessing worldwide?
Well, Frank, it may have started today. And these people get tax-free, many of them, salaries out of the deal, and they then impose their theories upon the general public. And the idea that the IMF and the central bankers prevented the crash in 2008 from getting worse is ludicrous.
Yeah.
I mean, it was a classic 1929 crash. Even the percent drops in some of the stocks were of that order. And then it also reveals a great vacancy in economic theories. And this is the idea that unless they intervene, a crash will last forever. I mean, what nonsense. All the great crashes in history, or most of them, have happened in the fall and have concluded, by November, when you do the test kind of thing. And this was during periods when the central banks were crazy, and also at the time when the central banks were responsible. So this is utter garbage, and why the taxpayers should pay for her salary plus allow her to get by tax-free is an outrage.
Thank you, Frank, for your question. And how about another crazy government idea, daylight saving time? That ends this weekend.
Oh, you had to bring that up.
Yeah.
I hate that thing. It changes an hour. But, there's no reason now. I think there's some stories about the 1914-18 war where they adjusted the time in the summertime so that the farmers would have more time to get the harvest in. I mean, really. But it's only recently I discovered really what it's all about. They want everybody to get up and change their clocks and then do it again 6 months later, whenever they do. And the other evening, Lois and I were sitting there in the house cat, out on the deck, and you're sitting quietly, doors closed, and wants in. Get up, open the door. In for 2 minutes and wants out. So, but when we're not there, the cat's not at the door playing the door game. So here it is. It's the policymakers are just like cats. They're playing the door game. They love to see you get up and do something totally useless.
And they're not as cute and friendly as cats.
Oh, no, of course not. Yeah.
We're talking to Bob Hoye from Institutional Advisors here on This Week in Money. This week's headlines, the final piece of economic data before the election in the U.S., the economy adding 171,000 jobs in October. President Obama says it's real progress, but Mitt Romney, of course, he's got to take the opposite view. He says it's simply more evidence of economic stagnation.
Yeah, well, who can believe the numbers anyways? They're cooking the books. Most of these government numbers are cooking the books. So, but you can't cook them when you talk about commodities, for example. And they have, last week they broke down. It was 302 was the previous support level. Last week they took out 300. That removed support. And now they're down to 296. And there's, minor support here. But these things can go head back down to the lows of last June, and that would be quite disappointing to everybody who is figuring inflation's going to come back in. And you've got weakness in crude oil, and within these, base metals have been stair-stepping down since the end of summer. So it's not a pretty sight in the commodity side.
Has not been a good picture in markets this week at all. Nearly almost 500,000 homes and businesses without power after Hurricane Sandy. Most of the market's been closed for the beginning of the week. Power coming back slowly later today, and stocks, of course, are falling, mostly based on that increase in October payrolls.
Well, if you want that idea, okay.
Sure.
But I just think that what you had here was you had in June, the markets were very oversold. Sentiment figures on the stock market were abysmal, and that was with the discovery that European countries were again, in default, insolvency, and they had a terrible market for their bonds and that. So that came in as an exceptional bearish sentiment on the stock market. And then, of course, you know what happens there. You got to get rid of the bearish sentiment. And the only way you do that is by changing it over to bullish sentiment, which on September 14th, you had commodities and you had stocks, you had junk bonds, all making really good sentiment and momentum high numbers, in which case you got to go down. And then you've had let's call it distractions of the election. And then, although it may seem callous, the distraction of that terrible storm that hit the East Coast. Now, that is a tragedy, but I don't think it changes the financial markets all that much, except put a few whipsaws in. And if a terrible storm is not bad enough, you then are going into the distraction of the election, which will be on Tuesday, and then it'll be over. If Obama wins, things could really be over.
It'll be interesting to see what happens.
Oh, well, the experiment in authoritarian government, he will figure that he's got a mandate for it, and away you go. But then electoral constraints and constitutional constraints haven't mattered to really ambitious Democrats anyway.
Here's one big indicator of what the market's going to do. Warren Buffett, his company Berkshire Hathaway, paying $500 million for a party favors and novelty company.
I can't believe that.
It's true.
Oh, well, okay. Well, if you said it. Yeah.
Or Oriental Trading Company is the name of the company.
Okay.
And so if Warren Buffett's getting into the party favors game, that's a leading indicator, I think. Mm-hmm. You were talking about the U.S. dollar index. It's climbed to 80.5, best level since September 7th. What does that tell us?
Okay. This was one of our indicators. So first of all, we had the Zoom, which completed on September 14th. So then you want to see some of our negative indicators to come in to say that, hey, this is really going to take a good hit. And one of them was the VIX model, VIX, that's volatility in the stock market. And it needed to rise above 16.5, and it did it a week and a bit ago. So there was number one, a first negative indicator accomplished. Then the other one was our old friend, the gold-silver ratio. It had to rise through 53, and last week it briefly hit 54. So there was the second, and these are important items. They've been reliable in the past. And then another one would be the dollar index rising above that 80.25. It sort of was flirting with it, and it didn't quite make it. And then as of today, it's up to this 80.5 level. So then that sets its near-term uptrend. And that's the third indicator. And then we had another one. Oh, yeah, the commodity index, the CRB. If it broke below 302, which it did last week.
Okay.
And then, as we mentioned, it's soggy this week. So there was another indicator. One left that we listed, one more that we listed, and has yet to do anything, is the BKX. That's the U.S. Bank and Financial Index, and it needs to get below 49, and it's around 50 now. So, but with these major ones, the four, having given negative signals, we think the natural way for the stock market is down.
Bob Hoye from Institutional Advisors, our guest here on This Week in Money. Let's talk about gold. We've been watching it carefully all week. Price dropping below technical support today at around 1682, lowest level since the end of August. What's going on here?
Yeah, well, again, the U.S. dollar index firming up. So those who trade gold in dollar terms would, of course, mark the price down. But in a financial storm, which we could be just entering now, the flight to liquidity is usually to the senior short-dated instruments in the senior currency, which is T-bills. That's probably going to be happening. And then the other one is the flight to the unique liquidity of gold, and that's going to be happening. So this then will slow gold's descent. But here, and this is working out already, Phil, because the silver on the week has set what we call an outside reversal to the downside. So this, in the last week, it's had a higher high than the week before, a lower low than the week before, and is closing out at low. So that's pretty reliable in saying that the trend is now likely to be down, so for silver. And then that fits in with the financial storm where silver gets dumped, and then the investment demand for gold more or less holds that, not necessarily in dollar terms, but is a bid for silver or for gold where the bid is going out of silver.
Okay, so they're saying in the media this morning that the gold price going down is based on the jobs report and a rally in the U.S. dollar. Once you remove the economic sleight of hand from all this, what are the fundamentals supporting gold and silver? What happens going forward from here?
Well, again, the gold-silver ratio at times of excitement, whether it is on the upside, the gold-silver ratio is an indicator. So, but this time now, when gold-silver ratio turns up, it says there's trouble ahead, and it turned up last week, and there is trouble arriving this week. And again, Phil, silver is the lesser metal, and gold is the monetary metal. So, as I said, that the demand for the unique liquidity of gold, careful, cautious, frightened money around the world heads into gold because it's liquid. And it doesn't into silver because it doesn't represent the same quality or the same liquidity. So this is where silver's failure this week is extremely important. So we've been figuring that the gold and silver stocks would decline with a probable decline in the general stock markets, and that seems to be working out. So, but this in the gold and silver stocks is heading towards a terrific buy when this move concludes. Who knows? It might last for, I don't know whether through November or whatever, but we'll have the chart works looking for the buy opportunity as it comes in. And then if you get stability in the general stock markets, you can then begin to see the gold shares really outperforming the general stock markets, mainly because their real price of gold is going up, which reflects operating margins for the gold sector. And the same thing when basic commodity prices are down or weak, it reflects pricing problems for most of industry and commerce. So it's going to be another phase of reminding people of what a post-bubble contraction is all about. Other than sometimes the violence as being incredible, we're in the path of a typical post-bubble contraction.
Is the thing going to continue in the next couple of weeks? More contraction coming up?
Oh, yeah.
Okay.
No, this is just early stages of stocks heading down. And then the other thing is that there's nothing the policymakers can do about it. They made all their promises in September. Remember, they had the head of the ECB and the European Central Bank was going to buy everything, and then on September 13th, Bernanke got up and said he was going to buy subprime mortgage bonds. And then all of these things crested on September 14th the next day. So the fix, or the notion that the markets could be fixed, was in the market on September 14th.
Already priced in.
Already priced in.
Okay.
So now here we go again. And as this thing bottoms at some time in the next 4 or 5 weeks, you don't know exactly when until you get there. And then it turns up, then afterwards, those guys in policy will be going around saying, oh, hey, we stopped it from turning into something worse.
Let's give ourselves a raise.
Yeah, and tax-free, too.
Bob Hoye is Chief Financial Strategist for Institutional Advisors, and he writes Pivotal Events, a weekly overview. You can find out more at institutionaladvisors.com. Hey, Bob, thank you, and have a great weekend.
Okay, Phil.
This Week in Money is archived online at talkdigitalnetwork.com.
Jeff Berwick is founder and chief editor of the Dollar Vigilante. It's a free market financial newsletter, and he's online at dollarvigilante.com. Today, he's talking to us from Santo Domingo, Dominican Republic. Jeff, what's going on down there?
Hey, Phil. Great to talk to you. It's been a while. I'm just down here. We're working on our usual kind of stuff, helping to free the slaves, trying to get some passport programs going on here in the Dominican Republic.
You've had a busy fall. You've been to Chicago for the Hard Assets Investment Conference. You were in Toronto for the Resource Investment Conference there, and just back from the Silver Summit in Spokane, not just wrapped. What's the kind of mood been at these things all summer long?
Well, the Silver Summit's quite interesting. It's kind of the kind of people who've been around this market for 20 or 30 years, so they don't really change too much. They just go there for a good time, and that's what we tried to have there. But I got kicked out of the hotel because I told a waitress she had nice eyes, so I guess the U.S. hasn't changed too much in the last few years.
Same old, huh? Jeff Berwick from dollarvigilante.com here with us on This Week in Money. Less than a week to go, Jeff, till the U.S. presidential election. You read the mainstream media, it's either too close to call or both parties are predicting disaster if the other side wins. And you're raising a good point in the latest Dollar Vigilante. You're saying, hey, does it really matter who wins?
Yeah, it really doesn't. You're saying it's too close to call. That's because they're exactly the same. Both of them, Obama and Obama, they're all calling for the exact same thing. It's amazing how the political and elite class have mastered these elections now to actually have two people calling for exactly the same thing and still give the illusion of choice. Both of them are calling for Guantanamo Bay to continue to be open, even though that Obama ran last time on closing it. They still, both of them, support torture. They obviously both support war. That's one of the biggest things to me is, people look at this election and think that it's important. It's really not all that important to most people, but it's actually important to people in the Middle East and Africa because depending on who wins, that's going to decide which country gets bombed next. So that's really the only difference. That they're both for bailouts. They're both for medical, socialized medicine or a medical system. They're both for cronyism, drones, TSA. There's really no difference between the two of them, and it's really a waste of time to even watch it. I only watch it sort of like a sadist watching a car crash, just out of curiosity, but it really makes no difference at this point.
A couple of weeks back, Jeff, we talked to Gerald Celente, great guy who was here in Vancouver, and he brought up the same point that you bring up, is it's the lesser of two evils, depending on who you vote for, right?
Yeah, people always say that, well, I have to vote for this guy because he's not as bad as the other guy. Well, how is voting for evil been working out for you? This has been going on now for decades. The apparatus of the U.S. government, which is now the biggest opponent to liberty on earth and the most dangerous entity on earth by far, has the capability to destroy the world in 10 times over, 100 times over. It's just getting worse and worse and bigger. And the more that you even play into their game and even try to play it by voting, the more you are actually giving your consent to it. Really, nothing really is going to change with this election. Everything's going to be the same. We're going to have to stick with the same thing we've been sticking with for a number of years, which is hard assets that Ben Bernanke can't counterfeit, and expatriating your assets and even your ass if you can. Get out of your own country or at least get a second passport and get ready because the Western nation states, including Canada, will all begin to collapse in the next few years. There's too much debt, and they're printing money like crazy. They all believe in this Keynesian they're all Keynesian Kool-Aid drinkers, and they believe that the more you print money, the more prosperous and wealthy we are. And you only have to look back to Zimbabwe or Weimar Germany to see how that works out.
In terms of investment, in terms of making money, you say again, doesn't really matter what happens.
No, it doesn't. Nothing's going to change, whether it's Obama or Obama or Obamni. There's no change at all. There's just slight differences. Maybe one likes abortion, one doesn't, or one likes gay marriage and one doesn't. These are all just fluff questions. They're the exact same on the important questions, which are should we? I'll give you one example. The Federal Reserve was not brought up in any of the debates. That should be the number one topic. Is the central bank, which is now doing QE to infinity and going to destroy the currency. But of course, they have to do that if the government's going to continue with trillion-dollar debt deficits, which both sides plan on continuing. Whether they spend it on war or on welfare is the only real difference.
Jeff Berwick from Dollar Vigilante, our guest here on This Week in Money. Pretty hard to get a reading on the markets this week with all the craziness from Hurricane Sandy. But what's the market telling us to expect from the election? Now, can we get any kind of reading from the markets on what's going on?
Like I said, I don't really think there is any difference. So I'm not even watching the markets for any indication because there's not going to be any change at all. I think more interesting is what happened during the hurricane. You really see the big government come out, and they of course, all the big fallacies come out during a hurricane like the one that hit New York. That we need big government to protect us from natural disasters, and that natural disasters are good for the economy, which is what a lot of Keynesians believe. They believe in the broken window fallacy, that any sort of destruction is good because it creates jobs. Well, if that's the case, I'm going to go over to Paul Krugman's house and light it on fire and see how he likes it. He'll be busy for a while.
Break some of his windows.
Yeah, he'll be busy for a while, but he definitely won't be much wealthier.
Now, some folks may not have heard of the broken window theory. Tell me what the broken window is all about.
Sure. A lot of people who don't really follow economics aren't aware of this, but this is a common fallacy, and it's always brought up by people called Keynesians who believe in the distorted and sick theories of John Maynard Keynes, that destruction is good because it creates jobs. So let's go through the broken window fallacy, for example. So if you have a house and a kid breaks your window, are you richer or poorer? Obviously, you're a little bit poor. You have to pay to get another window. But according to Keynesians, you have to hire someone to repair your window. Therefore, you've just created a job. But if you take that theory to its ultimate end, then you would say, well, let's just burn down every city, and then we'll all be really busy rebuilding the cities, and we'll all be much more wealthy. It makes no sense whatsoever, except to really people who can't even think beyond the first wave of what happens of something, which is what most Keynesians and government people are. They can't actually see second or third things that happen when something happens. They just see the first thing. They just see the guy come up and fix the window, but they don't actually think beyond that. Obviously, destruction is not good for anybody, but if you listen to the New York Times or Paul Krugman or a lot of people in the U.S. government or the central banks, they actually look at the hurricane as a good thing for the economy.
We're talking to Jeff Berwick from DollarVigilante.com. Interesting story we were talking about a little earlier on, thanks to Mark Howe at Mining.com for bringing this up. A secret report by Germany's Federal Audit Office says the Fed in New York refuses to allow the Germans to see their gold. And now they think that, maybe there isn't any gold in the Federal Reserve at all.
Yeah, it's unbelievable that the German government would allow its gold to be held by another government. I guess that's probably a leftover from World War II or something. I'm actually not familiar with the whole history of it, but that must be the case because the whole reason for owning gold is to have some sort of wealth and to have it out of the control of the financial system or anyone else. So to have the Federal Reserve store your gold is pretty much the last thing you would want to do. I read I saw on CNBC, they were trying to say that, you have to trust the Federal Reserve. If they say it's there, it's there. Well, sure. That's the last person you would want to trust is a central bank. A central bank is a tenet of communism, and it's just a way of making people more poor and transferring wealth to the super elite and financial elite. So to store your gold, which is the exact antithesis of central bank. A central bank and gold are two ends of a different thing. To actually store your gold with a central bank is the last thing you'd want to do. And we'll see what happens with Germany here. I'm sure they'll never see it.
Jeff, let's talk about the gold standard. How do you feel about it? You think it's a good idea, returning to the gold standard?
I really believe that money should be left in the hands of the free market. And whatever the free market wants to call money is what should be money. And then before governments and before central banks, it was gold. When you talk about a gold standard, that generally means having the government still run the money system, but actually having it backed by gold. That's better than what we have today, which is a completely fiat system, and we've been on that system since 1971. So that's better. But the true best case scenario, there's no reason government should be involved in anything, much less the money system. It's much too important to leave up to the government. And so, yes, I would support it as far as it's better, but I would hope that the free market would really run the money system and allow all kinds of currencies to compete, including things like Bitcoin or any sort of invention or any commodity. Who knows what the free market would come up with if we didn't have the state all over it.
Great line here from Malcolm Forbes in Forbes magazine. The Gold and the Wicked Magicians is the latest article by him. And he says there are two powerful forces opposed to the gold standard: the inherent rapaciousness of big government and the conceit of economists who believe that economies can be guided like steering an automobile.
Yeah, you bring up an automobile. Ford was the one who said that if people understood the monetary system, there'd be a revolution tomorrow, and that's absolutely the case. Most people just don't understand, and that's why they put you in the public indoctrination camps for 12 years, is to make sure that you never understand, you never can think critically, or if you can, you're just a rarity. They will never teach you what the money system is or how it works, because if everyone understood it, they definitely wouldn't like it at all. And so that's what this whole system's been about now for the last centuries, since the Federal Reserve was founded in 1913, so we're almost 100 years into it. That most people just have no clue what's going on with the monetary system, and that's the biggest thing that government tries to do, is to make sure that no one ever understands it, because if they did, there would be a revolution tomorrow, because people would not put up with basically the entire central bank system is a way to impoverish most people and just transfer wealth to the financial elites.
Jeff Berwick from DollarVigilante.com, our guest here on This Week in Money. And for folks who are thinking about gold, who want to move past the day-to-day headlines, you have a great guy working for you who we've known for some time, Ed Bugos. He writes about gold in the Dollar Vigilante. Good guy.
He's a great guy, and he's our senior analyst, and he's one of the smartest guys in this sector. He's been promoting gold since 2000, which was pretty good timing, at about $200, and now it's, of course, about $1,700. And he's calling for $3,500 to $5,000 gold, and I think that's really being conservative. He's one of the best Austrian scholars on earth, and he really follows the money supply, and that's all you really need to do to understand where gold's going, is to follow the increase of the money supply, which now, thanks to Ben Bernanke, is QE to an infinity.
Yeah.
So he's basically guaranteed that there's going to be a major gold mania, and it hasn't even started yet.
State of the Bull Market is Ed Bugos' latest at DollarVigilante.com, and check that out. You might want to think about subscribing. Jeff, tell us how we can get involved.
Yeah, if you just go to our website, just DollarVigilante.com, you just put your email right in the box right on the front page, and we'll send you our blog every day, and we have a paid newsletter, and you can just click on subscribe if you're interested, and we talk about all these kind of things every single week.
Also should slip in a plug for the Vancouver Resource Investment Conference. That's coming up January 20th and 21st next year, and details at CambridgeHouse.com. You've been going to a lot of these things, Jeff.
Yeah, I'm trying to get out there. I think this is the most important time in human history. We're going to be heading into a complete monetary system collapse, a global monetary system collapse. So I'm trying to get out there and spread the word before it's too late, because the more people understand what's going on, the better the collapse will be, and also the better the what happens after the collapse will be. The more people who understand free markets, capitalism, and anarchism or libertarianism, the more that we can rebuild a better world after this all collapses.
Sounds like a great idea. Jeff Berwick, founder and chief editor of the Dollar Vigilante. He's online at DollarVigilante.com. Hey, Jeff, as always, thanks for talking to us.
My pleasure, Phil.
This Week in Money is archived online at TalkDigitalNetwork.com.
Ben Rabidoux focuses on behavioral economics, consumer debt dynamics, and the role of housing in the broader Canadian economy. You can find him online. Great site, too. Want you to check it out, theeconomicanalyst.com. Hey, Ben, how are you doing?
Hey, I'm doing great. How are you doing out there on the West Coast?
We are doing fine. We want to look at the latest figures here from the folks at CREA and get your take on it. Housing sales up 2.5% in September, but the national average down 15% on a year-over-year basis. And the CREA folks, of course, want to put some spin on it. They're saying the market remains firmly in balanced territory.
Yeah. You know what? Okay, first of all, you have to start. So when they mention that sales were up 2.5%, that's on a seasonally adjusted basis, and that's on a month-over-month basis. And what you have to know there is, because there's some seasonality in the data, that they'll say, okay, well, because September sales tend to fall month-over-month relative to August, then we'll adjust one way or the other, right, to kind of be able to compare it one month to the next. And basically, their seasonal adjustment this past September was the highest September seasonal adjustment ever, which was really interesting. So, you know, yes, I guess you could say they were up month over month, but only when they seasonally adjust it massively higher. And they don't make those calculations real clear. There's nowhere where you can find out the methodology for how they do that. So it's a bit of a black box. I take that sort of stuff, when they seasonally adjust things, I take that with a grain of salt. I much prefer to look at just the year-over-year comparisons, 1 month from 1 year to the same month the previous year.
Okay, so why the big jump in seasonal adjustment, and is there any meaningful trend here that we can determine?
Well, okay, so there was a huge jump because part of the seasonal adjustment was that this September we had a couple fewer weekdays than most Septembers.
Okay.
And that's valid, I get that. But this was not the first year where we've seen fewer weekdays, right? I mean, we had the same number of weekdays. You go back to 2001, I think there was another year, 2005 maybe or something. And if you look at the seasonal adjustments on those years, they weren't nearly as large as this year. So it's certainly a head-scratcher in my mind how we had such a huge seasonal adjusted jump. Like I said, it's a black box. I tend to ignore their seasonal adjustments and just look, like I said, at the year-over-year stuff, which it gives you a nice clean comparison. You compare 1 month, 1 year to the same month previous year, or previous 5 years to kind of establish a trend for that month, and it kind of gives you a better sense of what's really happening.
Okay, so let's pull back a little bit and look at the trends. What's going on trend-wise with real estate?
Well, I mean, there's no glossing over September. It was a pretty bad month for sales in Canada, and of course part of the blame is being put on the new mortgage rules. You and I chatted about those mortgage rules months ago, and I said, look, these are a big deal, and people are finally starting to realize just how much this market has been driven by credit, right? I've always chuckled when people say, oh, the housing market's being supported by economic fundamentals and incomes and everything else, and I've always said, look, you constrain credit just a tiny bit, and you'll see sales fall off a cliff.
Sure.
This is not driven by fundamentals. This market's being driven by credit expansion. And the moment that you try to rein in that debt-fueled market, you're going to see sales fall off a cliff. And that's exactly what we had. So it's no surprise that these mortgage rules have had that effect. The only thing that I would point out, the BC Real Estate Board, especially in Vancouver, they were quick to point the finger at these mortgage rule changes. The reality is, if you go back to February and March, we were already at decade lows for sales in Vancouver. And that was well before these new mortgage rule changes came into effect. So there's more going on there than just these mortgage rule changes. Yes, I think that was a big hit to demand, but Vancouver was already wilting well before that. So you'd asked about the trends. So basically, if you look at sales on a year-over-year basis, you had Vancouver down about 33%, Toronto was down 23%, Montreal and Ottawa both down 17, 18%. The lone bright spot was Calgary, which was actually up quite a bit.
We are talking to Ben Rabidoux here on This Week in Money. What do you make of this story from CIBC Chief Economist Benjamin Tal? Of course, they are a mortgage lender, so you've got to be a little bit suspect here. But he's saying Canada will avoid a U.S.-style real estate meltdown. What do you think?
Well, it was actually a pretty good report. I agree with a lot of what he said, and I've never said we're in line for a U.S.-style housing bust. I've always said, if you look at what happened in the U.S., you had the greatest destruction of wealth for the middle class in history, right? And, I've always said it's very dangerous for us to say, look, we're not going to have a U.S.-style correction, therefore everything's going to be fine. And in my mind, that's an enormous jump. And so I've never believed we're going to have a U.S.-style meltdown, just simply because I don't see the flow of credit coming to a virtual stop like it did in the U.S. But that being said, I still think we're in for a world of hurt. So I think the report was solid in that it discussed things like, there's a lot of people. People say, well, we have a recourse here in Canada, and that's going to protect people from walking away. And Ben Tal did a great job of kind of dismissing that and showing the data of the U.S., which I've highlighted on my own website numerous times. He looked at a number of other things, mortgage deductibility in the States. It's not the reason why they ran up their credit bubble. So he did a good job with that. I disagree with his assessment on a number of levels that we don't have a credit issue, an underwriting issue here in Canada. I don't believe that we have gone to the same extent that the U.S. has in some of their mortgage lending stupidity. But we're certainly not prudent, and you run into issues in transferring terms between countries. So things like subprime and prime and Alt-A, they don't mean the same thing in Canada and the U.S. So subprime in the U.S., we really haven't seen anything quite comparable. We had some really nasty lending practices in Canada kind of leading up to 2007, 2008, and a lot of those were curtailed after the recession and the crisis. So, I mean, we had, full stated income, 40-year amortization, no money down. I mean, just, interest-only nonsense mortgages that were very subprime by every sense of the word. And those have, by and large, been curtailed. But the real issue in Canada, I believe, is in the Alt-A market. And what we find is if you look at prime U.S. mortgages, the documentation requirements are vastly superior to what we call prime mortgages here in Canada. They're not comparable, right? So you're looking at 2 years full, usually 2 to 3 years full documented income. You're looking at full physical property appraisal, rather than automatic valuation systems. I mean, those terms are not directly comparable. So, I'd just be hesitant looking at the Canadian landscape and saying that really we're going to be okay. I don't believe that at all. And at the end of the day, when you look at the debt figures between Canada and the U.S., and no matter how you slice it, whether you look at consumer debt relative to income or relative to GDP, we're every bit as bad as the U.S. was at peak. And I've often said, how have we run up our credit to the same extent that they have, but only ever extended credit to people who had the full capacity to repay? It just doesn't jive with me. It doesn't pass the smell test. I think the data increasingly is starting to support that too.
We're talking to Ben Rabidoux here on This Week in Money, and we're talking about the CIBC report about housing. Benjamin Tall saying home prices in Vancouver and Toronto likely to slip as sales fall. Here's something from the Wall Street Journal. Vancouver home sales reporting dropping 33% in September compared to a year ago. Listings rose 14%, and now prices and sales are falling. Give us an update on what's going on in Vancouver, Ben.
Right. So, we talked about sales being down about 30%. If you look at things like, total listings in Vancouver, they're up about 14%. And when you start to look at total listings relative to sales, then you can calculate what's called the months of inventory. So in other words, how long it would take to clear the current inventory given that month's level of sales. And we're at about 12, or we were at about 12 in September. So to put that in perspective, that's very high. There's a lot of inventory relative to current sales. So in other words, supply and demand are not balanced at all. And when you see months of inventory rise up into kind of the double digits, it's a virtual guarantee that prices are going to weaken going forward until that kind of balances back out. So prices are starting to fall. We've got every measure of house prices in Vancouver are showing them negative year over year. So whether that's the CREA average, the Terranet, the house price index, everything is pointing to prices falling. And that's a trend that's going to continue as long as you have this huge imbalance between supply and demand. And frankly, I don't see that changing anytime soon. I think what's happening right now in Vancouver is a lot of people are kind of thinking back to the last time that sales were this ugly, and it was really 2008. And what we saw is sales kind of tanked 2008 into early 2009, but then came roaring back, and inventory just evaporated off the market, and prices basically shot higher. And I think that's been ingrained in people's minds now, that any temporary pullback in sales in Vancouver is followed by a massive surge higher, right? And I don't see that happening this time, because if you think back to what happened in 2008, you had the Bank of Canada crater rates by 3%.
Yeah.
So basically from 3.25% down to 1/4 in 8 months, right? You had mortgage rates, so the 5-year fixed fell 2% in 8 months. And then you also had CMHC and the government taking out these or starting these aggressive programs to stimulate lending and keep the flow of credit going into real estate lending. Now, today, we have the fundamentally opposite dynamic at play. You've got rates that are really as low as, there's a bit of downside, but they're extremely low. And And rather than trying to make credit more available and get credit flowing into the economy, you've got regulators actually doing the opposite, trying to tighten it. So I don't see where the demand is going to come from unless it's just going to be an enormous surge of demand from foreign investors or some sort of massive capital flow. And anecdotally, it sounds like that's slowing as well. And it doesn't seem like that's set to turn a corner anytime soon.
Ben Rabidoux, our guest here on This Week in Money. We've talked about the policy changes and about how the industry doesn't like what Ottawa has done. But one of the factors we have to consider, of course, not policy, but the Canadian economy itself. It is slowing down, and that's got to affect housing.
Well, it will. It definitely will. I mean, that's been one of the things I've been kind of pounding the table on for a long time. Is if you look at how disproportionately reliant the Canadian economy is right now on things like residential construction and the FIRE industries, finance, insurance, real estate services, which are collectively, those are kind of a proxy for housing activity in the country. Our economy is very tethered to those, and we've seen those sectors of the economy start to represent an increasingly large component of GDP growth. And that's concerning, and it's just not something that's going to continue indefinitely when you've got prices at these levels, when you've got sales slowing. I mean, it's necessary for those things to kind of move back in line with their historic norms, and that's going to involve a period of, I think, some fairly significant pain for the economy. I hate to kind of just be a bear on that, but that's just what I see. I mean,
Sure.
You couple that with the fact that you've got Canadian consumers who are basically tapped out, and their capacity to continue to borrow to fund consumption is really it's limited going forward. So, you're basically at a point where we need things like business investment to really and exports to really pick up and provide the heavy lifting for GDP growth. And I don't know that that's going to be there. So, I think the Canadian economy, unfortunately, is going to weaken substantially throughout 2013 and probably into 2014 as well. I think we talk about GDP growth being slow right now. I think it's slow, and it's just going to get worse, frankly.
If you have wondered what's going on in Vancouver real estate, what's coming up, it's good news. Ben is coming to Vancouver for a real estate and investment seminar. Vancouver Real Estate, what's next? It's at the Westin Bayshore in Vancouver, Wednesday, November 28th at 7 p.m. And you can get more details at Real Estate 2013. That's Real Estate 2013.ca. Ben, tell me what we can expect at the seminar.
Yeah, I'm looking really forward to it. I think it should be a good time. We're going to just walk through some of the stuff you and I have talked about. We're going to look at some of the latest data coming out of Vancouver. People who know me, who've read my work, know I'm a huge graph freak, so I just love looking at the data and being able to present it in a clear way. So we're going to see what's happening, latest data on sales and inventory levels and construction activity. We're going to look at BC in particular, look at the GDP there and what a real estate correction would mean. And then we're also going to kind of zoom back to the 10,000-foot level and look Canada-wide what it would mean here in Canada. And again, I hate to be a bear on all this stuff, but it's when you see the data presented in front of you, it's very obvious that the economy is facing a really rough patch coming up. And so the question is, well, what do you do about that from an investment perspective? And so I'm going to be joined by, it's actually being sponsored by David Lepoidevin at the Lepoidevin Group, and he's just a fabulous money manager here in Canada, manages about $500 million, and just has done a great job for his clients at hedging out risk in the past. And so he's going to discuss some of the strategies that he's using right now for clients to kind of protect them from what we see as being a major kind of risk to the economy and what that could mean for things like the banks and other key investments.
Vancouver Real Estate, what's next at the Westin Bayshore in Vancouver, Wednesday, November 28th, 7 p.m. Got a couple of numbers here for you, 604-623-6768 or toll free, 1-800-233-0833, or you can check out all the details at realestate2013.ca. Hey, Ben, always good to talk to you. Thank you, sir.
Yeah, it's been my pleasure. Great chat.
Thanks to our guests, Bob Hoye, Jeff Berwick, and Ben Rabidoux. And thank you for listening. I'm Phil Mackesy for AmericanManganeseInc.com. We're back next week with another edition of This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.